Traders, Brian here with another video titled Tops and Bottoms. This video is going to be a little bit longer than my normal videos, but we got a few things to talk about in here. So let's get right to it. Purpose of the video is to provide traders a simple method to identify tops and bottoms in the NQ futures markets. This all came about from all the research I do after hours to the flagship model, what I call Optimus. All right. Additional resources and sites where traders help traders. Of course, my room, mine and my son's room, Blockchain Cartel Discord. It's free. Here's the link. And then, of course, James's site, Elite Futures Discord, where you can go. It's just a huge variety of indicators, templates, traders with their, providing their story, their trades, how they tackle the markets. It's a really good variety site where you can get a lot of variety. I just focus on my method up here. All right, agenda is we can talk about the end state, the indicators required, the discussion of what we're looking for, and then some techniques. All right, here's the end states to create an intraday NQ top and bottom model. All right, so we're going to go into this in great detail, but I'm just going to give you the lay of the land on this slide here. So here we have Ninjarinko bars 22.4. My default template always set to Ninjarinko bars with silver bars. I make the wicks extra thick and the outline of the bars extra thick, and then I use markers to color the bars for a variety of reasons. All right, so here is a 216 EMA channel, which I really like to use. Here we have a potential low. Bars are colored blue because this oscillator struck below this threshold. Here we have a potential high. Bars are red because the oscillator struck this critical threshold level right here. Okay. This is a well-chosen example. We're going to go through all the different varieties here, but this is a well-chosen example right here. There are many that look like this right here, but this is picture perfect. This thing just keeps going down. All right, I think that's all I need to talk about on this slide. Yep. Okay. All right, indicators required. So the indicators that are organic to NinjaTrader 8, the only thing you need for this is the moving average envelopes. And I have to put a warning here is that this setup that I'm showing you about right now is designed specifically for the NQ. Any other symbols, this method will work on any other symbol, but for the techniques and the setups and everything, you're going to need to tweak the moving average envelope, that ATR setting in there, the percentage setting to reflect the respective bar size. So I just want to toss that out there. Now I use markers plus to create the oscillator simply by subtracting the close from the 216 EMA, and then I color the bars blue and red when the oscillator registers being in extreme territory. Okay. One thing that I could not find, and I hate this, is I couldn't find a suitable free price oscillator that is simple enough that just subtracts the price from whatever you want to subtract it from. In this case, it's the 216 EMA. The NinjaTrader 8 price oscillator is nothing more than MACD. That's all it is. It doesn't work. The MACD works similarly to subtracting price from the 216 EMA, but it's like, I'll say, when I looked at it, it's about 70% accurate. So this is the purest. This is the purest way to create this, is actually measuring the distance from the 216 EMA. All right. So this indicator not required. This is just my order entry module, which is a paid indicator. And here are the Indy 8 indicators. So just disregard this 54. Not going to talk about that in this video. It's just really the 216. Okay. And these are the markers plus modules that I have. Alright, here's the settings for the 216 EMA channel, and it's the moving average envelope. You can see right there. So that's really what you need to get the moving average envelope set in place. And at some point in time, after this video is made, I'm sure somebody's going to get in touch with me and let me know, hey, here's a price oscillator that'll do what you want, that's free. And once I get that, I'll put that back out, for everybody, make that available. All right, so let's get into the meat of this thing right here. And so basically, how can we identify potential tops and bottoms or exhaustion points? Now, I know everybody's seen all these wazoo indicators that, I won't name any of the vendors' names, but they come up with them. I've tried them all. I don't like them. I don't like them one little bit. Could never get them adjusted to make any sense. I went back to just the basics, and so the question I kept asking myself is centered around the 216 EMA. So the 216 EMA has always fascinated me, and it's integral to many of the functions I program into trend models and also use to define the trading environment. So one of the questions I asked after I looked at all these different indicators was, let me get back to basics and let me just ask the question, how far away does price typically move from the 216 EMA before it snaps back? So in Markers Plus, I can quickly and objectively define the relationship and also prepare several courses of action for how to take advantage of the potential snapback from a low or a high. So the first step is to subtract the close from the 216 EMA. This will produce a simple oscillator. That's what this is, the simple oscillator. So anytime price moves above the 216 EMA, the oscillator goes above zero and flips blue. Anytime it moves back below 216 EMA, it flips red and goes below zero. So this whole move right here was below zero, and then here we get the bars are colored blue because it's below that extreme. Here, oscillators above this extreme threshold, and bars are colored red. All right, so we subtract the close from the 216 EMA, and we get that oscillator. All right, now next step is to determine what threshold levels are extreme, and this just goes back. It's an eyeball look at 90 days worth of data. So I came up with 40 and negative 40. So it appears that when the oscillator moves above 40 and then below negative 40, these mark extreme distances away from the 216 EMA. And I have to stress again, this is for the NQ. There may be different settings for different. You have to fine-tune this for each symbol that you're using, okay? All right, now I use markers to color the bars blue for potential lows and red for potential highs. And that just marks off when the oscillator is above that threshold and below this threshold. All right, so now that we have that identified, we've talked about price flipping above, flipping below, but for those of you that are in the trading room, any crossover that I reference, the crossovers can be very noisy. So we always like to use an oscillator and threshold levels to determine what level does the oscillator need to puncture in order for a sustained trend to potentially emerge. So that's what this final step is about, is to also look at this as a trend indicator. So we have the extreme and we have a trend module. So these yellow lines set at 12 and negative 12, those are the trend threshold models. Familiar, it's the same as the threshold levels for the BLT trigger line histogram that we use, that I use in Optimus. This one just uses price moving away from the 216 EMA. All right, so punctures of the 12 to the upside indicate that there's potential for a continuation in the bullish trend. Punctures, we can't see on this one the first time it punctured negative 12, but had a very nice down move through there. Okay, so again, I prefer to keep the bars in this model silver so I can just see the bars highlight. All right, so the takeaways from what we just talked about. Potential lows can be identified when the price oscillator is below negative 40, and I paint the bars blue with markers. Potential highs can be identified when the oscillator is above 40, and I paint the bars red. Price tends to trend when the oscillator punctures the 12 threshold for bullish trades and punctures negative 12 for bearish trades. So the key is puncture, pullback. As long as it doesn't exceed, the bullish pullback doesn't exceed negative 12, you want to take those pullback trades. Here it punctures, somewhere here, pullback. That's the pullback. You just take that trade, try to stay with it for as much as you can, whatever your trade plan says. Okay. All right, so now how do we use it? We have several techniques. We'll talk about technique 1 first. Now I know this is a busy slide, but it has everything baked into it, so you can just stop this, take a look at it, and walk through it. I'm going to go through it pretty quick, but here's technique 1. Technique 1 is after the oscillator registers an extreme price, you are going to take the first high or low or the first low or high. So here's the sequence of events. I'm just going to talk about bullish trades first. Everything that I talk about here in this description is opposite for bearish trades. All right, so for bullish setups, the oscillator will be below the negative 40 threshold, here and here. All right, after the oscillator moves, this is the bullish chart right here we're looking at, bullish counter trend trade. So after the oscillator moves above the negative 40 threshold, there will be a first pullback in price. It's very important that when price pulls back, the oscillator's pullback cannot go back below the negative 40 threshold. This would negate the setup. All right, so we're below, we move above, we get a pullback. You can see here, this is a good example. We're below, we move above, we pull back, and it goes back. So it negates the trade. We have to go back and reset again. So here we move back above, we're below negative 40, we move above negative 40, we come in here, we pull back. This is the pullback, and you're buying, if it up closes, then you're buying that up close plus a tick. And you can see here that the pullback never came close to the negative 40. So you take that trade. Your first objective is back inside the channel. That's your first objective. If you don't get any more than that, then, that was a nice trade right there. That's probably, if you've got a 50 tick, you probably would have gotten 50 ticks on that right there. That was a really nice trade. If you're getting 5, hey, that's good. You always want to make sure you put this trade on where you have at least 5 points to get back inside the channel. All right, so here we have first objective met, and you could have, for me, that would have been a day done trade right there in, my accounts. All right, so here's another one. It's below negative 40. Oscillator moves above negative 40. You get the first pullback right here, and up close plus a tick, you get in. So it's trade management rules. I personally give these a lot of room to wiggle out. You have to make that decision for yourself. The most logical place to put the stop is below that low. That's a big move down. That's probably 20 handles or more to the downside. Once you get in here, 25 probably. So you've got to figure out if you want to take that risk or if you just want to cut it in half to get the trade. But I'm trying to stay in these trades until I get back into the objective. Now, this entry here, you had 1, 2, 3, 4, 5 highs, which would have put you at least if you were trading this normally, you know, I would have maybe have breaking even on this trade right here. It would have came back and had a break even trade. But that's my normal trade plan. I don't trade these normally. I give them a lot more room to wiggle around with. So if you're still in that one, you get your first objective met here. Now, second objective is if you get up inside this and you're trailing and it gets deep inside the channel, hey, if you've got some profits and you can just raise your stop to right below the channel here, then you stand the potential for, you know, getting in a trade. You get outside the channel, then you can raise your stop up to, you know, underneath. Just keep trailing the 216 EMA until you decide you've had enough. So that's kind of the objective of this, is when you get the runners, then you're just trailing up and you can get those outsized moves. That's the whole intent of this bottom picking thing. Number one, it kind of gives you a look at where a potential bottom can be put in. You know how the NASDAQ moves. This thing can just rocket ship off of a bottom when they're done. When they've met their objectives, they're done. Yeah, this thing can move. All right, so that's the bullish trade. It's just the opposite for the bearish. This is pretty interesting. These trades, this trade right here this bearish trade was actually this past Friday, May 31st. And so here we have a move. We're above 40. Bars are red. And we come down. First pullback. You see it right here. Turns down. You get in. That's a super nice trade to get back into the channel. I mean, monster trade right there if you're a scalper. So you got 15 handles or more of meat on that right there, even if you let that pop back up. So beautiful trade. So here you have another one. It touches back above. Bars are red. We come down. First pullback. You don't know if this thing's going to rocket ship back up or not, but take the first down close, and you definitely got 5 points there. Depending on how you trade, there's probably more to be had in that trade. I would have moved mine to at least 5 points, locked in 5, and probably would have been taken out on the push back up. So here was these are all hypothetical trades. Here, this wasn't hypothetical. This was the high of the day. I showed this in the room. I got short exactly where this lower high pullback was. I actually just sold into it. I didn't, and I actually sold into it right in here. This is where when it started moving up right there, I got short. This was the first trade I'd ever taken based on the research, and I hadn't really worked out the entry mechanisms until last night. But excuse me. But I just went ahead and got short there for a variety of reasons. There was a level up here that was critical. I had another timing factor that said this potentially could have been a high, and I had this research I had been doing, so I just took the short trade there. That was the high of the day. The market dropped Friday on the 21st or 31st. I mean, it dropped 410 points from 410 or 412 points from where my entry price was. That was a beautiful short. How much did I get out of that 410 points? I got 7 points. So I didn't have my entry mechanisms fully worked out, and I just traded a 400-point down move in the worst possible way you could imagine. So anyway, this is the logic behind this, and yeah, it's pretty neat. I think it's pretty neat. All right, this is technique number 2. Again, this is an entry technique. In this entry technique 2 is the first swing high or swing low breakout. So you can use, for those of you that like to use a swing indicator, this is another way to get into the trade. All right, so sequence of events. Again, for the bullish trade, I'll explain that, and then we'll cover the charts here. It's opposite for the bearish trades. Oscillator will be below 40. You can see we're all the way down here. We come up, we make a higher low here, but we're using the swing high breakout, and this swing high doesn't break this. You're looking for that breakout to go long. It doesn't happen. You get a retracement back again. It just tickles the threshold, turns one bar blue, comes back out of the, crosses back above negative 40, another pullback. It doesn't touch. It comes back up. So now we're waiting. Crosses the swing high breakout there. You get a little John Wick, and then bam, look at that move there. That was just absolutely beautiful. So this is one where you could, you've got a really nice profit. You lock in either here or at the 216 for your second objective, and if you can trail that move right there, that ended up being another really, really big mover. So anyway, that's how you can trade that. Same objectives, the whole 9 yards. So we just talked about the bullish. Now let's just look at the bearish. Again, we come down, we get the first pullback right there, and it comes down and it cracks that swing low. So you get into trade short there. You're just trying to hang on. Again, I've got my stop set somewhere up here, and you're just trying to hang on to this trade to try to get what you can out of it. So you get the first objective there. Super nice trade after that little pullback flushes down. So there is a lot of meat on that bone right there. So that's another, for me, that's way past my day done if I catch that trade. And then if you're fortunate enough to hang on still, I've got to work on that myself. I'm not very good at hanging on. I'm still a scalper by nature. So, but anyway, I think the picture pretty much paints the explanation for you. So let's move on. Technique 3 is probably the most conservative, maybe the most conservative. Jury's still out on that, but it's technique 3 is simply waiting for the oscillator to move from the extreme threshold levels to go to and through the trend thresholds of 12 for bullish trades and negative 12 for bearish trades, and then take the first pullback trade. This technique's entry is all about waiting for a potentially safer entry. So let's just walk through one of them. Again, this is a bullish trade, opposite for bearish. So the bullish setup starts with the oscillator below the negative 40 threshold level. All right, then it moves above, and it moves through the negative 12 level. All right, so now you're waiting for the first pullback after the oscillator moves through 12, negative 12. You're looking at this pullback went back through negative 12, so you're going to wait. Even though that would have been an awesome trade, you're going to wait. You make another thrust up. The first pullback after this thing goes through negative 12, the first pullback that comes down and doesn't cross back down below negative 12, you take that up close. And that was a very nice trade there. Super nice trade. So again, this trade's all about waiting for the extreme to take place, for the move outside of the extreme level through, on the bullish trades, through negative 12. You waiting for the first pullback that happens that doesn't cross back down below the negative 12, and then you take that trade. All right, let's look at a bearish trade. All right, so starts out with the oscillator above the negative threshold, above the 40 threshold, I should say. Bars are red. We come down. Oscillator comes down. It crosses through 12 right here. All right, first pullback is right here, and you want to take that first down. So I would have been in right here, and again on this trade I have got a little bit wider stop than I normally carry with my normal trades. So I'm back above this back above the 216 EMA channel is typically where you're going to see me put a initial stop if I'm using this entry method. Like here, I would have been back down below the 216 EMA channel. All right, so you're trying to hang on to this trade, and it wiggles a little bit, but once she gets back fully under the 216, nothing ever penetrates that 12 threshold. This pullback doesn't either. I kind of have it hidden from the arrow, but this pullback here does not exceed that 12 level. So we'd flush back down again, and that's all you're trying to do is hold the trade until you either get your move down or it penetrates back through this level. You don't want to be in the trade at that point. Okay, that's telling you that you're either getting into a choppy environment or the trend. This down move was just to shake people out, and this is truly what they want to do, go back up. So it's pretty neat. It's a pretty neat way to objectively identify those first pullbacks, and then a way to know you're absolutely wrong if it goes against you, instead of just them and they manipulating the market. I mean, you truly know from a mathematical objective standpoint, a point that makes sense, that we know that if we penetrate this to the downside, or if this comes back and penetrates it to the upside, we just want to be out of that trade. We're wrong. Okay? So it's a pretty neat way to use this. All right, trend technique number 4 has nothing to do about highs or lows. It's just simply about using this model as a trend tool. So that's all it is, using the oscillator as a trend model. So again, just to review the bidding here, when price simply crosses over and under the 216 EMA, the oscillator registers a blue bar above 0. These blue probes coincide when it pokes its head above the 216, comes back below, it's red, goes back above, it's blue. Okay? Flip-flopping back and forth is very noisy, but we want to know what threshold level holds the key for a meaningful thrust and continuation, both for bullish and bearish trends. And it appears, after the research I've done, that level for the NQ is 12 and negative 12. Again, I'm using 22.4 bars on the NQ. All right, so let's look at the sequence of events. First thing we want to see is for the oscillator to puncture the 12 threshold level to the upside. That's what this blue vertical line represents. And in markers, you can automate this right here if you wanted to. You can automate the buy. You could automatically drop vertical lines in, whatever you want to do. So oscillator moves through the 12 level. So now we're looking at first pullback, up close, plus tick, we take it. Pull back, up close, tick, we take it. You take as many of those so you get day done. I'm not sitting here trading all those. If I took this one and got my 50 ticks, that'd be day done. Okay, if I'm still just trading to be trading, and you're taking all these trades. Pretty self-explanatory. This is a perfect example. Again, we have a deep pullback into the 216. We get red indicating it's below the 216, but look, it never, when it reverses and we go blue again, it never comes below, never even comes close to the negative 12 threshold. So again, we're mathematically, objectively determining where the potential good trades are on these pullbacks, and that's the aspect of this that I love the most. Okay, and again, you're just taking those trades, trying to hang on to them. All right, same thing works for the bearish scenario. This is another good example. So we cross negative 12 here on the oscillator. I manually dropped a red vertical line there. It's just so you know, to the right of that, we're looking for short trades. To the right over here, we're looking for long trades. All right, short setup. We drop down below, we get the first pullback. It does not exceed the 12 level, so we're taking that down plus a tick. I would have been stopped out for a break even because I'm trying to get 50 ticks. I would have been stopped out on this at a break even plus 1 or 2 ticks. All right, we get another pullback. It doesn't exceed the threshold, so we take the down close plus a tick, and bam, look at that trade. Beautiful. All right, we're red, pullback. This one doesn't even get close to 0 before it reverses, and then it's just Katie bar the door straight down. So that's it right there. That's 4 techniques you can use with this simple oscillator. And I'm really sorry I can't find a free NinjaTrader indicator that I can quickly create this. I'm not a programmer, so I don't know how to script in NinjaTrader. But if anybody out there has one, just drop it into either the YouTube channel or come over to the Discord room. Let me know where it's at, and I'll make sure that gets disseminated at the widest levels. So anyway, that is, I think that is that's my last slide right there. So let's just go back and usually put a review summary slide in. I didn't on this one, just wanted to get to it. So what we talked about was creating an intraday top and bottom model. We talked about 3 techniques on how to get in to a trade using the top and bottom model approach. Okay, 3 techniques to get in using that. Then we talked about technique 4, which was simply using this as a trend model. So this is pretty good because this is a choppy chart right here, where it's you're going to get losses with this thing without a doubt. But you can see here, starting from the left, we come down, we get the pullback. It doesn't even get close to the negative 12, so I'm taking that. And I've got to stop above the swing high, survive that, get my money, and that's what I'm looking for there. So I'm looking for the first trades. I don't know if this is first or second trade in sequence without looking back to the left. But here I would have taken a loss. We don't get long until, see, this is the beauty of this. This is the beauty of this. This is actually an excellent. So we would not have taken this trade because we never punctured the 12. Yeah, I hadn't even seen this until now. So this is awesome. All right, so this is chop. We're not getting into it. We puncture it to the downside. We rally all the way back, and we do not puncture to the bullish 12 level. That's awesome. So you're actually clear to take this trade. I would not have because it was just a lot of chop, but you still had a lot of me. That would have been my 50 ticks right there for sure. So that was awesome. Now it stopped short again. It never tickled this one, so this is telling you we're in a ranged market. But now we get to punch back up through. We come down. We don't touch it. I would have gotten into this and would have, because of how I do my stops, there was at least 7 points of profit there, so I would have been taken out at a break even, plus 1 or 2 ticks. Here we have a down move. We're flip flopping here, wide movements. We're down, so now I'm waiting for the first pullback that doesn't exceed this to go down. We don't get it. Instead we actually puncture to the upside. We come back down. It doesn't even cross below 0, and we get back up. All right, so I remember this trade now because had I been using this, I don't think I would have lost this trade here because this would have kept me on the right side. I know it wouldn't have. I'm just talking myself through it, and I remember this because I was so I won't say distraught because I missed this trade, because I lost on this one and didn't shake the cobwebs loose. But this shows me I should have never taken. I tried to go short somewhere. Yeah, I tried to take the John Wick is what happened. I tried to take this John Wick, and yeah, that's ill-advised following this model. So yeah, that was a bonehead trade on my part all the way around. Man, I'm glad I actually reviewed this slide, because this is awesome. But then I turned around. This was a puncture, comes back, and we don't even go below zero before we close back up again. So it's yeah, in my flagship model, that was a clean trade to take as well. So this would just, kept me on the right track. Anyway, this was a really good example here of showing how to use those threshold levels for the trend trade. So, well, anyway, I think that sums up everything. Hopefully, this has been a help for markers users. I'll have this template posted in my room before Monday morning, and as soon as I get the NinjaTrader 8, free indicator that can produce the price oscillator like this, I'll get that back out to everybody. Anyway, if you're trading with us in the room, we'll see you at the opening bell.